Okay, guys, what we're going to do in this video is we're going to show you the top 5 search stocks in our software by our community members in 2022. So that's 11 months and a week, give or take, correct?
Yeah.
We're going to compare this to what we see trending out there in terms of what Yahoo shows as people's most searched stocks. So the reason this matters is we have this channel of value investing, and value investing is not the same as hype investing. It's quite the opposite. Value investors do value growth. We just don't like to overpay for growth. We will pay a premium for growth, but most investors out there see a lot of growth and think it's growing like crazy. I need to own it. Right, Mo?
Yeah, absolutely. It's crazy.
It's nuts because there's such a thing as overpaying for a good thing. The example I give is this iPhone's a great phone, iPhone 14. Whatever the price is, $1,200. Well, if it's so wonderful, pay $10,000. Paul, it's ridiculous. To me, it's no different than when you see a company that has a lot of potential that you pay through the nose for it.
Pay $800 all day.
Yes, I will pay $800 or $1,000 even for a good thing as a value investor. Now, even if the company does grow, go back to 2000 and now. Intel, Cisco, HP, all these companies have grown in revenue and profit since 2000. They have not hit their 2000 peak. Maybe not Hewlett Packard, HPQ, but definitely Intel and definitely Cisco. Yeah. The 5th best stock, the 5th most looked up stock, not best, PayPal. So PayPal is interesting, and here's why I like our community, guys. Look at PayPal this year. Year to date, the stock is down 63%, and it's still one of our most searched stock. That's what's awesome. Imagine this. In the world of regular investing, people see a stock down 63% and they avoid it. Like, this is it.
Move on.
Our community members go, wow, here's a great company and it's down 63%. Let me go take a deeper look at it.
Yeah. Because the financials make sense.
Because the financials make sense, make more sense. Because the all-time high was July 25th of 2021 at $310. The low, 52-week low is $67, and it's currently sitting at $72 a share. Yep. So let's go actually look at the 8 pillars. All right, guys. So here we're showing a better price to free cash flow than earnings ratio, which is fine. I'd rather have it that way than the other way around. They're buying back slight number of shares,
great
reasonable debt,
capital.
Great return on invested capital. This is a very important metric for growth in a company. A company with a high return on invested capital shows they potentially have a good moat, and if they can repeat this consistently over time, then they can reinvest the capital in the business to generate faster and faster gains in earnings and free cash flow.
Check out the market cap to enterprise value.
So there's a lot of debt here, 83 billion versus 132 billion. That means there's debt there, which I'm okay with because look, they can easily manage that. And their free cash flow, very consistent and growing. So analyst estimates. Here's their EPS growth for the next few, very consistent. It's going to double according to analysts over the next 4 years, which is over 20%, which is about 20% growth per year in earnings per share. And revenue, not much growth. So this is an example of how ROIC works. Not as much growth in revenue, but big growth in earnings. Yeah. All right?
Yep.
So let's run our stock analyzer tool on this company. So Mo, are you going to do a 10-year or 20-year analysis?
I'm going to do a 10-year.
Okay, I'll do 20. So you do 10, I'll do 20. Okay. And guys, keep in mind, as Mo does this and I do this, a 20-year analysis in our software will give you a lower price. 10-year analysis give a higher price based on certain situations. So revenue growth. Okay. So guys, I'm looking here and you might look at this and say, Paul, revenue growth is 10, 16, and 18 over the last 1, 5, and 10. Why are you doing 4, 7, and 10? Guys, it's very difficult for companies to grow at these high growth rates for 20 years at a time.
Hard to continue that.
It's hard to continue that. My goal is to be conservative. I still put a high number of 10 on the high side because this would still, what would this do? This would still quadruple? No. So 10%, it doubles every 7. It triple the revenue over the next 20 years.
So 27 is their revenue right now.
So it's taken the $81 billion. Yeah. I can see a path to that. You might sit there and say, Paul, that's too low. It very well could be, but if you saw, the analyst estimates for the next 5 years were not that high.
It's like 7 on the high side if you average it out.
But I want to put some major high number in there. Yeah. Profit margin, last year was a little bit lower. I'm going to basically ignore the 1-year fluke. I'm doing 13, 14, 15. Free cash flow margin, very consistent. So I'm going to stick with 19.5, 21, and 22.5. All right. PE. Okay, this is the interesting one. So I'm going to go Probably a higher P. It seems like their free cash flow is better than their earnings.
It's funny because I'm doing a 10-year analysis and all my numbers are lower.
Oh, interesting.
Yeah. So keep going.
Okay. So PE, I'm going to go with 15, 17, 19. Price of free, no, sorry. 16, 18, 20. Price of free cash flow, 15, 17, 19. Desired return, guys. I'm going to do 12, 14, and 16%. Remember, as I go higher, I want a higher desired return that gives me my margin of safety. The higher my assumptions, the bigger margin of safety I need because it's less likely to hit. Mo, what were your assumptions?
So my assumptions were for a 10-year analysis. 2, 4, and 6 for revenue growth. That's what I see over the next decade. Profit margin, 8, 11, and 14. Price to free cash flow margin, 19, 20, and 21. PE 14, 16, 18. Same for price to free cash flow. And my return 12, 14, and 16.
All right, Mo, what are your numbers?
Let's see. 21 to 52 on the low end. High end, 44 to 67. And my middle ground is probably 32 to 59.
My low, 40 to 60. Yeah. High, 70 to 100. Middle price, 50 to 80, roughly.
You have it on your watch list at 60.
I have it on my watch list at 60 because I do think there's a lot of competition coming to market here. And I don't, and it's got, I'm kind of stuck on this one. I could easily justify paying $70 a share for this thing right now, right? Selling puts on it. But I just want to be a little more conservative. Mo, what were your middle numbers?
My middle numbers were 32, 50 to 60.
So I look at these things thinking to myself, okay, let me change my analysis to 10 years and see what it goes to.
Let me change mine to 20 and see what it goes to.
Analyze. Okay. It went up higher. I still like my 60. I just want to be conservative.
Yeah. Mine's, I guess you could look at 20 to 60 is my range of the whole thing.
And you might sit there and say, boy, that's a big range. Well, guys, it's 20 years.
Exactly.
The further out you go, slight differences today make a huge difference later. So it's natural that there's such a big swing. So guys, this is only one company we've done. If this seems overwhelming or this tool seems hard because we hear it, it's fine. There are thousands of people in here that use it. All it takes is repetition. I was confused when I first started this whole process. It gets much easier. Just need to repeat over and over again. And we have a special at the end of this video. I'll explain to you that you can get the software at an incredible deal. So anyhow, stock number 4, Alibaba. All right, we're not going to do stock analyzer tool on Baba, but I'm just going to show you, this is a highly searched stock. Why? Again, guys, look at this. Year to date, down 25%. 5 years, over 5 years, it's down 46%. All-time high of 320, 52-week low of $58. And interesting, Mo, tell us what you said about the $58 level beforehand.
Oh, that $58 level is going to be that support level.
And he was saying this at like $70 a share.
I was saying that in like the hundreds, I think.
Were you?
Yeah. I mean, it's very obvious. It was on the chart. It was extremely obvious. I could pull it up if you want me to.
No, it's not necessary.
But no, but that's exactly what it was. And you just look at different support levels and 58 was the number.
So this is a way of which us combining value with charts. Mo was only a chart guy. I was only a value guy. Now we both do both, and we do options. So this is part of the process that we've done on this channel as a way of where there are people on the channel who make thousands of dollars a month doing chart reading, day trading, long-term trading, swing trading, etc.
Incredible.
Yep. Stock number 3, Intel, INTC.
This is big in the news today because Taiwan Semiconductors is releasing their new plant.
Oh, really?
Yeah. $40 billion plant in Arizona.
And again, 1 year chart on Intel, down 43%.
This is one of those companies. It has not touched its high from 2000.
And that's what I was talking about. Exactly. Look at this, guys. And profit and revenue have doubled and tripled over the last 22 years, and the stock is still below it. Why? This is overpaying. Guys, every investment's the present value of all future cash flow. And if you pay too much for that future cash flow, you're going to make crap returns.
So in 2000, they did $33.25 billion in revenue.
Sick. They did $70 billion last year after dropping $10 billion.
And the stock price has not returned.
That's awesome.
Amazing.
Analyst estimates, they're expecting 50%. Oh, wow. Big growth in their EPS. Not much growth in their revenue, but the EPS growth is pretty large.
Yeah.
High return on invested capital is over a 5-year period. Recently, it hasn't been because they're investing so much money. Look at their free cash flow. It's dropped big time. Why? Because they're investing a lot into that big plant and other plants around the country.
I'm interested to see if this revenue number here changes because this is only through 2024, and I think that they're supposed to start their production in 2025.
Yeah, they're talking about the big turnaround taking into 2025 to happen.
So.
But again, Is it the third most popular stock to view on our software this year has been Intel. All right, second one, Meta, our friend Meta. Now, Monish Pabrai, who we interviewed last year, thinks Meta is a 10-bagger, right?
Yeah.
Which means he thinks the stock is going to go from 115 to 1150 at some point in the future or something along those lines. We can't confirm or deny. I don't know. But all I know is I own Meta. I enjoy it. It's fallen a lot, has a high return on invested capital of 16.9%, a low PE, great gross margin, 80% gross margin, higher than Palantir.
Wow.
Bottom line profit has been affected because of this metaverse. And guess what, guys? The metaverse is costing $10 billion a year.
And here's the thing. People keep talking about, oh, it's 10, what are they doing? What are they doing? Guys, they can afford to do this.
Correct.
It's not like they're just borrowing like crazy and they can afford it. If they screw up for 2-3 years in a row in this and then just call it a day, it's going to be fine.
Yeah.
And then they put $10 billion back. I mean, we're good.
I think this is an example of the news hurting a stock more. Yeah. But again, do your research. Look at analyst estimates. Analyst estimates for profit are an increase of 60% over the next 4 or 5 years. And again, don't take analysts as like this is the be all and end all, but it's just a way of like looking at saying, hey, these guys talk to these companies a lot and there are a lot of analysts out there. Maybe they're right. Maybe they're not right. The bottom line is at $16 a share in 2026, even at 15 times that, what are you at here? 240? 240. That's easily a double up from there.
Can't see that far.
Can't see that far? All right.
I don't have 2010 vision like you.
Yeah, 2015 it was. 2015. I don't know if it still is, though. All right, final stock. Number one stock of 2022, researched by our good friends of the community, thousands and thousands of people. We're talking about hundreds and hundreds of thousands of searches across these 5 stocks.
Before we do this one,
yeah,
why don't we look at Yahoo real quick?
Oh yeah, let's look at Yahoo.
So these are the trending tickers right now. This is not over a year or anything, but you can see the difference in these types of companies that people are looking at. Right now, we're looking at on Yahoo, Lucid, GitLab, Salesforce, Gossamer, Com Sovereign. Do you know what these are?
No idea.
Textron, Summit Therapeutics. I mean,
NRG is big.
Right here, AZO and Signet. Those are two that I...
By the way, you see Signet, $70 a share.
Let's not talk about it.
Yeah, too soon.
But guys, this is the mentality. I mean, look at this price right here, 13 cents. What is going on here?
Yeah.
Come on.
So our number one company of 2022, Apple. The good old Apple. I'm actually surprised. Actually, I'm not surprised. One thing I want to mention, Tesla's not in this number. You would have thought Tesla,
Rivian. I mean,
and Tesla's down a ton. You would think if people really thought it was value, they'd look at, I think Tesla will be one of our big searches though, when Tesla falls.
Yeah. The market will dictate what those searches are. And I think Tesla will be one.
Yeah. Once it starts to fall within a reasonable level, because that's what our community is. It's people who believe that when you buy a stock, you're buying a piece of a business. You're buying a piece of cash flow in the future. And if you can't accurately determine how much it's going to make in cash flow and earnings over the next 10 or 20 years, and you can't pay a reasonable price, then you avoid it. It's that simple.
Absolutely.
So, guys, the deal we're offering is 1 month risk-free. Join the community, pay for a month. If within 30 days you don't find the value, which I'm very confident you will, email us. You'll get your money back on that 1 month, no questions asked. Thank you very much for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?